Well, hi everyone, it's Russell from Enhanced Asset Management with a quick update on some of the portfolio changes that have occurred recently, with most notably being the fact that we've used some of the strength in both global and domestic share markets to reduce your exposure to listed equities, with most of those sales coming from sell down in some of your US holdings. Now, I'll just move on to the first slide, and as we show here, despite persistent inflation readings, interest rates only moving up, one of the largest banking crises we have seen outside the GFC, concerns of recessions, not only here locally, but also in Europe and the US, we're seeing equity markets pretty much do this and put on a strong rally. Now, to put this in perspective, our ASX 200 has added around 9% for the financial year, but the graph I show here, the S&P 500 has put on almost double this or over double this with a 19% gain over the last 12 months. Indeed, since its October 24 lows, the S&P has added almost 25%, as we can show here. And it means it's basically in a new technical bull market, if you can believe it. Now, it's a very interesting rally for a number of reasons. Now, first, this bull rally has literally started with valuations being high and not low. We started this bull market with a forward price to earnings ratio of 18 times in October last year, which isn't exactly cheap. In the past, valuations in bear markets have offered very low multiples of 13, 14, 15 times, and we just haven't seen that now. And currently the market sits at about 21 times forward, which is typically very expensive. And secondly, and most interestingly is this rally has been pretty much driven by one sector, the technology sector. 90% of the return that you can see here, that's right, 90% has been driven by the technology sector, which in our view, it's not a sign of a healthy bull market. Perhaps even more strikingly, if we move on to the next graphic, is we can show that out of the 500 stocks that make up the S&P 500, it's taking just seven of those stocks have accounted for 84% of the market's return. Only seven. Apple, Microsoft, Nvidia alone are responsible for more than half the market's return this year. Alphabet, Amazon, Meta, and Tesla contributing another 34 or 35% this year. Now, if we took these companies out of the equation, the S&P reported about a 2, maybe 2.5% return for the full year, meaning we wouldn't even be talking about a bull market at the moment. Literally, I cannot remember another market like it which has been driven by such few stocks. Now, in this next slide, you can see the outsized returns driven by these handful of names. Nvidia, for example, up 192%, Meta 134%, Tesla 112%, and the other four all north of up to 40% returns. Now, a key driver of this rally this year has been investor excitement over these firms' investments in AI software. Nvidia, for example, has rallied on a surge in demand for its chips, which have been used to train programs like ChatGPT, which I'm sure you've all heard of. Microsoft, Alphabet, Apple, Meta have all ventured into AI tools for their products and services. Many of them have already incorporated AI into their platforms. They're all searching for that next level of efficiency, automation, data-driven decision-making. And this has notably attracted investor attention and driven the strong returns that we have seen. Now, AI has literally been the single most important theme over the past year, outsizing everything else. And, I think one of the key advantages of our investment strategy has been on display for everyone to see, and that is the benefit of being invested broadly, which we've talked about multiple times before. Now, given this rally has literally been driven by 7 stocks, had you not been invested through the index, there's a very high chance that you would not have owned these companies. And there's a very, very, very high chance you would have underperformed massively. And indeed, many have, which is why it's been labeled probably the most hated bull market ever in history. But it's not for us, thankfully. And just as a reminder, as this chart shows, over the long-term horizon, 93.4% of all large cap funds underperform the S&P 500 over time. So, despite all this doom and gloom, this recent rally goes again to show the importance of not trying to time the market, the importance of sticking to a well laid out plan, and riding the inevitable ups and downs that come with a 10 to 15 year investment journey. Now, in saying this, through our journey together, there are periods where your portfolio understandably needs to be rebalanced to either increase risk exposure or reduce it. And, at the moment, it's that striking performance of the US stock market in particular that we have used as a bit of an opportunity just to take some risk off the table. Not all, just some, but we have reduced it a little bit. So that's all for me today. I hope this video finds you well, and it is the end of the financial year, so happy end of financial year, and we look forward to whatever 2024 brings us. Bye for now.